We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Rick Rule, investor, speculator, founder, and CEO of Rule Investment Media. How are you today, Rick?
Tom, I'm great. Always a pleasure to be with you. Thank you for having me back on.
Of course, it's always my pleasure to speak with you here today. And of course, the last time you and I spoke, I asked you how you see the importance of asking very high quality questions as an investor, questions that help investors, make decisions when looking at where they want to put their money in these, crazy and volatile times. So your response to me was that you had a lecture that was called 12 Nosy Questions that you've presented many times. So I was hoping today we could go over that and help to share that with our listeners here.
I think that's particularly topical, Tom. One, because as junior mining share prices fall, the opportunities for investors increase. It is important that investors know something about the value proposition offered up by a company before they worry too much about price. Mm-hmm. And learning how to do that, I think, is worthwhile. The second thing is that my mind is focused on it right now because, of course, we're putting on the Natural Resources Investment Symposium conference in Boca Raton, Florida. And one of the things that I've learned in 30 years of putting on conferences and seminars is that many of the attendees don't get full benefit from the conference because they haven't learned how to systematize the acquisition of information about exhibitors to make investment decisions. So I'm delighted to have the ability to address those topics with you today. It's merciful that it's fresh on my mind.
Absolutely. And of course, you're one of the best to be able to really provide this framework on which questions to ask and, based on your experience to really kind of guide people through that process. So what do you think is the best place to start?
I think why is the best place to start. Mm-hmm. Many speculators concern themselves with price information too much. The stock is selling for $1. The stock is selling for $2. That information is a floating abstraction. If you don't have an opinion as to what the range of current values might be, and what range of values might exist in the future. If a stock is selling for $1, but you think it's worth $2, that dollar information is valuable information because it relates to the price tag that you would experience for an undervalued asset. Similarly, if the stock was selling at $1 and you thought it was worth 50 cents, that's valuable information too. Most speculators pay attention to price information because they feel they can spend that. And of course, because it's very easy to obtain. The successful investors and speculators that I've run into in my life, myself included, have been people who have formed an opinion as to value. I should tell your listeners too, that you'll never get it exactly right. The search for perfection is a form of procrastination. The idea is to get it more right than your competitors and use those valuation expectations as a filter. So I think that's the sort of framework that I'd like to begin with. It's important for speculators to remember that a share isn't a floating abstraction. A share represents fractional ownership in a business. And buying a share involves buying fractional ownership of a business. So what is the business worth? What are the business risks? What do you expect the business to be worth if a series of things go right? And what are the probabilities of those things going right? The framework for today's discussion is probably just as important as the discussion. The other thing is it involves a lot of work. And some speculators seem to have an aversion to work, which is why they fail. This would be a really, really, really good time for people who want to hear an interview about why silver is going to go to $500 an ounce to tune out, because that's not what this is about. What this is about is how to become a better, more responsible equity investor and equity speculator.
So, Rick, when we think about the importance of asking these questions, the importance of doing the work, the importance of learning these skills, Is right now, while the Fed is raising rates, a good time to really be honing those skills and in some ways be sitting on cash? Because regardless of what you think, these companies could be worth, if we look at the macro environment of, supposed climbing rates and balance sheet runoff, this has affected the mining shares greatly over the past couple months. So do we have to take that into major consideration first, where we are in this macro cycle?
I think we do, but I think you need to take into context an old Warren Buffett quote: "The best time in the world to plant a tree is 35 years ago. Mm-hmm. The second best time is today." In other words, investing in yourself and investing in your education is always timely. Mm-hmm. It is likely in the near term, as interest rates rise and the US dollar strengthens, likely, not certain, that equities prices around natural resource companies decline, which is to say, it's likely that we're heading into a period of sales. If over 5 years you want to maximize your returns on capital employed, you attempt to concentrate your buying during periods of time when the asset classes that you would like to own are on sale. And I think we're coming into one of those. Most importantly, Tom, and I don't know if I'll be right on this, but I've watched a lot of issuers in the natural resources space postpone equity issuances, looking forward to higher share prices, in effect playing chicken with capital markets. And if the markets don't improve markedly in the next 6 months, those companies are going to run out of capital. Mm-hmm. And they are going to need to do private placements on terms and conditions that are more favorable to the check writers than they are to the check cashers. So honing your skills around understanding the value propositions and around understanding the pre-money valuations, I think is particularly important for accredited investors, people who will be looking to participate in private placement markets over the next 6 to 12 months, which I think have the probability of being the most attractive valuation points that we've seen for 2.5 or 3 years.
Yeah, absolutely. And all we have to do is kind of look at a chart of the GDX or GDXJ, SILJ, any of those to get a sense of how that macro environment affects the mining stocks. And as we talked about last time, considering these companies when they go on sale rather than the price action that makes everyone excited about them, right?
Yeah. I think the other thing that your listeners need to face, which is hard, is that the sector itself, the junior mining sector, is a destroyer of capital. If you merged every public junior mining company and junior explorer, there's maybe 2,000 of them listed worldwide, into one company, Junior Explorer Co. That company would lose in a good year $2 billion. Mm-hmm. It would lose in a bad year $6 billion. So, Tom, what should somebody pay for the right to lose $2 billion a year? Should they pay 8 times losses, 12 times losses, maybe 15 times losses in a good market? That little joke conceals the fact that maybe 10% of the issuers generate such extraordinary returns that it adds legitimacy and sometimes even luster to a sector that loses between $2 and $6 billion a year. Mm-hmm. The point of these screening questions is to allow the speculator to very quickly throw away 9 of the 10 opportunities that they may see in the course of a month. And focus rather than on the flotsam and jetsam, the opportunities which can really truly add value and performance to their portfolio.
Mm-hmm. So, Rick, before we get into the questions, should we be asking these directly to management? Is there places like, I can't remember the particular website. I think it's the Sedar website where we can glean a lot of this information from?
I mean, absolutely. Investors should have in their browser access to Sedar and Edgar, Sedar and Edgar being the Canadian and US regulatory websites, where issuers in these respective countries, are required to have all of the material public information available. And I've said on your show before that the number of shares the number of different companies in one's portfolio should correspond to the number of hours per month that one is willing to work understanding their portfolio companies. So if you're willing to work 10 hours a month, you should have no more than 10 stocks in your portfolio, which is to say that you need to read the annual report. You need to read the quarterly report. You need to read the proxy filings. You need to read the insider statements. You need to read the 43 101s. You need to familiarize yourself with all this information. In addition to that, however, you need to understand how management responds to questions around valuation and intention in your own portfolio. Maybe 1,000 people have said to me in my lifetime, Rick, these people will talk to you because you're Rick Rule. If a management team will not talk to you, they're saying something that's very, very important. They don't give a damn about you, and they don't give a damn about their cost of capital. In other words, if you can't get somebody in the company, hopefully the CEO or the CFO, to answer your questions, the company is telling you something, which is to say that they are inefficient at the acquisition of capital. They're telling you ahead of time because they don't want to talk to you, that you don't want to talk to them either. And that's very, very, very useful. What I have found for 4 decades of watching highly successful company builders is that the Robert Quartermains, the Ross Beatties, the Clive Johnsons, the Lucas Lundins, the Robert Friedlands would love to talk to you. What they're doing in building the company is the most important thing in their life. They don't care about baseball. They don't care about movies. They don't care about vacations. They don't care about popular cultures. They are thrilled when people talk to them about their companies. So if you don't have the ability to access information about a company, the company has no purpose in your portfolio.
Yeah, that's a great point, Rick. So where should we start? I found a rough list of these questions. So maybe a good place is, what is the current liquidation value of your company versus the market cap? Why is that important?
That's a really important question. When you go to talk to a Canadian junior or a junior, they'll say, well, the price is 30 cents a share. Well, why would that matter? How many shares are outstanding? In other words, what's the market valuing the whole country, the whole company for? And the logical question that springs from this is the company cheap or is the company expensive? Let's say, just for fun, that the company has 100 million shares outstanding. So the market capitalization is $30 million. That number by itself, if you don't have an opinion to value, is a floating abstraction. Mm-hmm. So I say to the companies, tell me what the liquidation value of your company is. Tell me how much cash you have in the treasury. Tell me how much of that cash you'll have to spend in the next 12 months. And give me a list of assets, property assets, or other assets. And don't tell me what the market cap of competitors are, but tell me approximately what you could sell these assets for if you took them to the street. Mm-hmm. Willing buyer and seller. The first thing you learn is that many issuers have never thought about that question. They don't have any idea what their company's worth. And if they don't have any idea about what the company's worth, in other words, if they haven't taken the time to understand something as important as what is your company worth, they're ill-equipped to answer any other question. If you have somebody who says, I've never thought about it in this fashion, they've said something very valuable to you. You don't have to ask them any more questions. You can go for coffee, you can go for a beer, you can do whatever you want. And I'm not trying to say that if a company has a $30 million market capitalization, that its liquidation value should be $45 or $50 million. I'm not trying to say that you need to buy dollars for dimes. Mm-hmm. What I'm trying to say is that when you are assessing the upside that might accrue to you from successful exploration, as an example, you juxtapose it with the downside. What will happen if the exploration is unsuccessful? If you think with some exploration success that the stock could go from 30 cents to $1, you need a grounding in what could happen if that doesn't come true. And so the question where you compare the net asset value of the company to the market capitalization of the company tells you something about the downside that you might experience as an investor. And it also tells you something about the probability or lack of probability that the company will be able to obtain subsequent financing on terms that are reasonable to your entry point.
Mm-hmm. And of course, there's so many questions to ask and, let's say, circumstances to understand within that as well. You know, if it's an exploration company, what kind of deposit are they on? What is the location, the logistical considerations? How far along are they? You know, all of those things go into valuing that type of asset, right?
Absolutely. And the consideration that the management team has put into all of those questions tells you something about their competence. Mm-hmm. Let's say, as an example, that you are evaluating an exploration stage company whose projects are in the Golden Triangle in northern BC. Very often, what will happen is the person will answer the question by saying, well, we have 30,000 acres.
Just up the road.
Tudor or Skeena or somebody has 36,000 acres and their market capitalization is 300 million. So these acres are worth X, with no description of the fact that, Skeena's acres have 4 million ounces of gold on them. Mm-hmm. You need to say to the person, I understand the rules of thumb. I can do that arithmetic. What I am trying to get you to tell me is what your properties are actually worth. Who would you sell them to? In my own lending business, Tom, when I'm looking at the value of collateral, I say to the company, assuming that you default, who is this property strategic to? Who needs to own this? And what do you think they'd be willing to pay for it and why? Now, you're always going to get an optimistic answer from an issuer if the issuer has thought enough about the question to have an answer. One of the things that you're trying to determine is whether the management team is competent enough to have thought about that question from a business point of view.
So, Rick, the one real critical or one of the real critical contents or points that you need to be making is about management and directors, right? So how important are they to the success in this mining market?
I would say more important in the exploration sector than anything else. Mm-hmm. Many people view the exploration business as an asset-intensive business. But if you view it from simple arithmetic, and the arithmetic is stark, 1 in 3,000 mineralized anomalies becomes a mine. If you're playing the asset game, you have a 1 in 3,000 statistical chance of success. Mm-hmm. These are not asset businesses. These are intellectual property businesses. And exploration really is a process of research and development. If you think about the exploration process the way that you would think about software development or biochemistry, you come to understand the true nature of exploration. So the explorationist initially is more important than the property. Exploration involves taking a piece of ground, delivering or developing an exploration thesis, and planning the most efficient way to test the thesis. Thinking about what subsequent steps might happen depending on what data is acquired. The people who put together the thesis and the people who implement the thesis are critically important. So the question that you asked is of itself of critical importance. And what you're doing when you're asking the company to describe their human resources is you're thinking about the probability that those people will be a success given the task at hand. And that involves several considerations. The first consideration goes to Pareto's law, which is the social science dictum that suggests that 20% of a population base generates 80% of the positive outcomes in that task. And interestingly, if you study Pareto's law, what you learn is that if you take that successful lip, that 20% who generates 80% of the utility, run it through the same performance dispersal curve, it conformably aligns, which is to suggest that 4% of the population, which is to say 20% of 20, generates 80% of the 80 by way of utility, which is by way of saying the 4% of the population base among junior explorcos generates well in excess of 60% of the positive utility. So the first thing that you're looking for is what successes has the existing management team, but in particular the CEO, enjoyed in the past. What you want to do is hang out with serially successful people. You want to hang out with Bob Quartermain, Lucas Lundin, Ross Beatty. You want to hang out with that 1% of issuers who have generated 40 to 45% of the economic successes. That doesn't mean that somebody who's never had a success before won't generate success. What it means is that the probability of it is so low that absent really extenuating circumstances, it isn't worth your while to try and participate in somebody's first success. You want to try and participate in somebody's third, fourth, fifth, or sixth success. Mm-hmm. The second thing is it goes deeper than the primary ego in the company. Why was the chairman of the board chosen? What specific expertise does he or she have that will lead to the successful implementation of the mission? What is the resume and what is the track record for success of the chief explorationist? If the chief explorationist alleges that he or she has been a success because they did mine development geology in 2 billion year old Archean rocks in French-speaking Quebec, but the task at hand is exploration rather than development for copper gold porphyries in 15 million year old accredited terrain in Spanish-speaking Peru, the resume success that geologist has enjoyed is irrelevant to the task at hand. Mm-hmm. Similarly, what's expected from the CFO? Is the task at hand one that involves going from a bankable feasibility study into production? Or is the task at hand something earlier on? Does the CFO have a constituency which already admires and trusts their work in a similar stage company? If the CFO will be required to structure financings and raise funds, has he or she been successful at that task in an exploration activity that is related to the task at hand for the company? In other words, you're looking for success in these people, and you're looking for a management team and a board of directors that have not merely experienced success, but have experienced success in tasks that prepare them for the task at hand.
So, Rick, you answered one of my questions there about, let's say, the chief explorationist needing to have relevant experience in that particular area that they're exploring. But, let's take the CFO, for example. Do you want to see CFO turnover as that business develops from an explorer to a developer or an actual producer? Is that something that that turnover of personnel that you want to actually see?
If need be. I want the chairman of the board and the CEO and preferably the CFO to say if circumstances change and the needs change, that the person will change. Mm-hmm. What you find is that teams' capabilities can mold over time. An example, a fairly recent example, would be West African gold, which took a grassroots exploration concession in the southern part of Burkina Faso. And although they had absolutely no construction experience on the board, as they progressed the deposit, that is, as they went from grassroots exploration to advanced exploration to development to construction, the team in place was able to add people that had competencies. So while the senior group of executives didn't change, they were able successfully to add intellectual capital at every stage of the game.
Mhm.
I was a little skeptical of their ability to do that. And as a consequence, as the share price increased and my skepticism with regards to their experience increased, I probably sold more stock earlier than I should have. But it's most important that applicable expertise occur earlier in the game when the risks are higher and the tasks are harder.
So, Rick, the next question that I have on the list here is, how are you going to make money on this deal, and when am I going to make it?
Yeah, the value proposition is really important, particularly in exploration. The process of exploration, as we said earlier, is really answering a series of unanswered questions. In exploration, it may be that you have a nice surface anomaly, and the unanswered question is this a scab or does it extend to depth? So the first proposal by which to test that thesis may be simply trenching. But you want the company to say, the most important unanswered question right now is this transported material or does it extend to depth? And the way we propose to test this is a trenching program. You need to determine as an investor if that is the most important unanswered question, and whether or not you can get an answer with the work proposal that is in fact proposed. That will tell you as a speculator, well, it won't tell you, it will give you the basis to begin to understand what a yes answer might be worth and what the probability of the yes answer is. Let's say that you have a surface anomaly that gives you enough of an expression that you could, if you were reasonably successful, imagine the deposit generating 1 million recoverable ounces of gold. And let's say that the first step in understanding the geometry and the tenor of the deposit is, in fact, a trenching program. Let's say, just for fun, that the company has a $10 million Canadian market capitalization. And let's say that you believe, or you're reasonably convinced by management, that answering the unanswered question, which is to say, developing a drill target with trenching, should double the market capitalization of the company, which is to say, the prospectivity of a 1 million ounce deposit, if it's determined that that's a reasonable target, should take a 10 million market capitalization company and make it a 20 million market capitalization company. And let's say that you believe this should take 1 field season. What you're able to do now is say, the first chance I'm going to have to make money will involve a yes answer around trenching. And I think that the dispersal of gold in the surface anomaly and the tenor of the gold, which is to say the grade, is such that there is in fact a probability that this is a homogeneous deposit that extends into primary rock. So I believe that I have a 60 or 70% chance of a yes answer, and I believe that I can obtain the yes answer in 1 field season. That means that your goal as a speculator is a 12-month double. You're assigning a 60 or 70% probability to that. And importantly, you're thinking too that the likely outcome of that first yes answer will be a drill program, which will, in the second and third field seasons, really flesh out that 1 million ounce deposit. So you can say to yourself, in conjunction with the management team that you pose the questions to, okay, I think that there's a 65% probability, as an example, that this trenching program will yield positive results and will establish beyond a reasonable doubt that the mineralization at decent tenor extends at least through the cover, through the till, into fresh rock. I think, too, that because of the size of the surface anomaly, if the trenching program yields drill targets, that there is a 50% chance that one of the resultant drill holes, at least, will give the company the motivation to continue. And I think that there's a 20% probability that the subsequent drill holes will give us the required further information with regards to the viability of the 1 million ounce target, that the market will be excited about the drill program. So in your own mind, you are proposing a schedule of answering unanswered questions, which allows you over a reasonable period of time to experience the benefits of compound knowledge. For myself, whenever I'm considering an early stage exploration venture, I want to believe that the first unanswered question can give me at least a double within 18 months. But I also want to believe that answering a series of unanswered questions gives me the ability, not the certainty, but the ability to generate a 10-to-1 return over 5 years. That's my own exploration model. Your readers may develop different exploration parameters, but it's important that you begin to understand what the unanswered question is, which is to say how you're going to make money and when you're going to make it.
Rick, have you ever seen, let's say, and does it raise a real red flag for you? Let's say, for example, an explorer that wants to, go into a trenching program, whose cost of, digging a trench or drilling the first couple holes, let's say cost per hole being extremely high, and therefore that ended up raising some real red flags for you?
There are two red flags that are common and scary. The first is the level of general and administrative expenditures relative to total expenditures. We had an intern some years ago who pulled probably an unrepresentative sample, I think 25 issuers from the Sedar database, and calculated the level of general and administrative expenditures relative to total expenditures. And the median of that 25 company sample was that over 60% of the money raised was spent on general and administrative expense, which is to say less than 40% went in the ground. That's a real red flag. If you and I proposed a work program on a joint venture basis with a major, they might assign us 12 to 15% of project expenditures by way of G&A. And so a company that delivers the same quality of work for 65% of G&A, G&A being 65% of total budget, is a money furnace. It's a place where speculative money goes to die. The second thing is maybe the opposite of what you suggested. When you have a company that is proposing a work program that has unrealistically low budgets for work relative to what you would expect. If somebody's saying that they're going to get work done in northern BC and they're going to get it done for $60 a meter, when your experience is that similar work programs have generated results for $150 a meter, that becomes a program. That becomes a problem. If somebody is proposing a trenching budget that doesn't involve the costs of, in northern BC, as an example, moving equipment by helicopter, by airlifting in drilling mud, by airlifting in diesel. In other words, if they're proposing exploration expenses for northwestern BC that are based on Nevada norms, where people can drive up to exploration targets on paved roads within 40 miles of their own living room, that's what really gives you cause for concern.
So, in that same vein, thinking about the amount of money that they need, how much money do they have? How much money do they need to make you rich?
Tom, that's absolutely critical. Absolutely critical. Let me give you a little story just to give your readers a chance to laugh and endure the rest of this lecture. About, I guess, 35 years ago, there was a conference that was a famous conference at that time, the Boston Gold Show. And I was attending. And after my keynote speech, I was no longer in suit and tie, but rather in a polo shirt, I guess less recognizable to some. And I remember walking around the exhibit hall and a young sort of hyper-aggressive white shoe promoter sort of tackled me in the aisle to show me his company, and they were going to do this and they were going to do that and they were going to drill. And remember, this is 35 years ago when money was scarce. And I said, that's a very aggressive program. How much money do you think it will take and where will you get it? And this young promoter, I guess, didn't recognize me. He said, well, that's where the intriguing investment thesis comes in. There's a real hot West Coast stockbroker named Rick Rule, and he wants to finance me, but he doesn't finance 50-cent deals. He needs to get to $2. So our hope is that we finance here at 50 cents and we generate some returns, and then we get him to finance us at $2. I really don't think that money's a problem. And I pulled out my driver's license and I said, money's a much bigger problem than you think, pal. Because your source of funds is highly unlikely to give you money in any circumstance. It is very important when somebody talks about answering an unanswered question. It's important that you ask them, how much time will it take to get the answer? How much money will it take to get the answer? How much money will it cost you in G&A to stay alive until you get the answer? And if you don't have that money on the balance sheet, where and how will you get the money? Very often the issuer will say, well, Haywood will give it to me. And I say, well, I'm a Haywood client. I can talk to them. Who at Haywood will give it to you? Mm-hmm. Who may I call so that if I want to participate in this financing, or I want to verify the fact that this financing will take place, who can I call? And by the way, what is their number? It's important to note, Tom, that if you ask these questions, when you ask, as an example, the median junior Explorco, what the most important unanswered question is, in my experience, 80% of them will say, oh, I've never thought about it in that context, which is to say they have no plan to succeed. Similarly, probably 80% of them are promoting work budgets which exceed the amount of cash they have available to them. And many of them have no earthly idea, particularly given the fact that they don't have enough money, when you might expect a yes answer. If people don't have the ability to deliver a yes answer, the probability that they're going to deliver the yes answer, which will meet your price targets, is nil. I guess I'll leave it there.
Next question is, how are you going to get it?
That means the money. Mm-hmm.
Okay.
And, I've sort of answered that. It's important that in addition to having a work plan on a property, that companies have a capitalization work plan. And how are you going to get it involves a constituency as much as anything else. If I say to Ross Beatty, how are you going to build this company? He says, I'm going to start with a starter asset that I believe is undervalued, that I and my staff are familiar with, and we're going to apply intellectual capital to this property in a way that hasn't been applied before. And the consequence of the increase in value that we're going to enjoy in this property will allow our market cap to increase to a point in time where our cost of capital is materially less, at which point in time we're going to add a second and a third and a fourth property. Mm-hmm. By the time we've added 5 or 6 properties, our scale will be such that we'll be ready for a U.S. listing and ready for indexing. And at that point in time, we'll probably sell our 5th best property. And I will have known that Ross has done this numerous times in the last 10 years. And I will say, Ross, who do you consider your constituency to be? Ross will say to me at the beginning of the discussion, I think high net worth U.S. retail, who I've relied on for 30 years, will be my first source of capital. I believe that my second source of capital will be the sophisticated gold funds. And my third source of capital will be generalist institutional investors, which is to say that Ross has identified the constituency necessary at each stage of growth. Mm-hmm. And if you ask him then what the probable levels of financing are, and what levels of technical growth will need to have been exhibited, he'll be able to answer the question. When you ask the lame, the halt, and the blind the same series of questions, they will be unable to answer it.
Mm-hmm. And again, that just points towards having those relationships and that experience really in place before you are trying to answer those hard questions, right?
Well, certainly if I'm understanding your question correctly, what the series of questions will do is allow you to identify management teams that have a probability of success, a high enough probability of success. As we talked about at the beginning of our dialogue, Tom, the idea isn't to spend copious amounts of time on each of 2,000 issuers, but rather to throw away 1,800 issuers so that you can focus first on 200 and later on 20. Mm-hmm. You are looking to segregate by, first of all, management, second of all, preparation, and third of all, assets, those companies that have the highest probability of generating speculative success for you.
So Rick, the how are you going to get it question doesn't necessarily pertain to the resource itself, more so the capital to explore that resource and get it out?
It absolutely positively can. Mm-hmm. I remember numerous A-League promoters that will say to me, well, Rick, in the first instance, a great property finances itself. And here's why this is a great property. If I've enjoyed success with that person before, and if their success relates to that type of geology or even that type of geography, I'm inclined to listen to them as to whether they have a great property. But if this great property thesis is being told to me by somebody who has failed twice before in mining, and by the way, then failed in pot stocks, technology, and crypto, I'm less inclined to believe that their opinion as to the quality of the property is something that I care about particularly.
Mm-hmm. So I think we might have kind of touched on a lot of this one, but what are your company's goals and what strategies will you use to reach those goals?
No, that's really important. There's a whole bunch of ways up the mountain. And what you learn is, as an example, Robert Friedland is an absolutely world-class district-scale explorer. Robert Friedland has the ability to hire experts who look at extensions of known mineralized terrains where they go undercover or something else happens, and develop a thesis around absolutely world-class ore bodies, which he then explores over long periods of time with absolutely crazy good results. So if Robert Friedland comes to me with the idea that he's going to do grassroots district scale exploration and come up with a tier 1 target, I'm inclined to believe him because he's done it 5 prior times in my career. Lucas Lundin, by contrast, may buy an asset that's in a part of the world that's too troubled for other people to go. I'm thinking Congo or Sudan or Syria or the high Andes, all of which he's gone to before, where there's wonderful expressions which could lead you to believe that there's a high quality target, but the work has been intermittent, as an example. And the consequence of that is that Lucas believes, with the right exposure to intellectual capital and physical capital, that he can take a project which has been ignored because of location, as an example. And if that's the thesis that is explained by Lucas Lundin, given the Lundin's family's track record in doing precisely that, I'm going to listen. I'm really, truly going to listen. Keith Neumeyer may say, I'm going to buy a producing asset that has been starved of capital, that's been ignored, that's been milked. And I believe with the proper application of intellectual capital and the proper application of physical capital, that I'm going to turn this property around, that I'm going to give it the love, the care, the attention that it deserves. And the consequence of that is that it's going to be an annuity for me, because Keith has done this successfully in the past. If he proposes this to me, I'm going to listen. What I'm going to listen to, too, is somebody who tells me a story that they don't have any track record in, but I'm not going to believe them. There are, if you study the great financiers, the great promoters, what you learn is that in their experience and in their team's experience, they learn how to do 2 or 3 things well. And if you give them their head in things that they do well, the outcome is likely to be good, or at least more likely than not.
So where's your owner?
That's critical too. I remember years and years and years ago going to a company presentation with Doug Casey in Vancouver. And I was asking all the normal nosy questions, the sort of detailed, nitpicky questions about various things. And in the middle of the interview, Doug says, "Hey, Rick, let's get out of here." He says this right in front of the issuer. "Let's get out of here." And I say, "Why, Doug?" He says, "Well, look right here. These guys don't own any stock. Why would they work their asses off to make us rich if they're not going to get rich too?
They need some skin in the game."
Yeah. So where is the owner is important. And it's important in several areas. First of all, in order to work for 5 or 6 or 7 years to make something a success, in order to work as hard as you have to work, both on the property and also in capital markets, in order to endure the risk, the payoff to you must be extraordinary. You absolutely positively have to do it. It has to be extraordinary. And if not just the CEO, not just the chairman, but if the management team, if the officers and directors aren't big shareholders, I don't care what they have to say. If they haven't managed to convince themselves, why would I allow them to convince me? Importantly, too, when I look at the big successful groups and I want to know who their other backers are, who outside of them are involved in the game, where can they go for money if they need it? What is the probability that they'll be able to obtain subsequent finance in the event of success or in the event of need on reasonable terms? It used to be when Adolf Lundin, before Lucas was running the Lundin family enterprise, I knew without a doubt that the biggest institutional investor in Sweden, Investor AB, was behind him. I knew that the West German financial institutions, Wintershall et al., were behind him. I knew that there were deep-pocketed investors who believed in what Adolf were doing and that they would support him. And that was useful. In other words, I knew who the owners were. I knew where the initial checks had come from. I knew where the subsequent checks were going to come from. I knew the investment banks that were likely to support him. And that's absolutely critical. And you don't have to know that about every issuer, but you absolutely have to be able to get the company to show you that officers and directors have enough of a stake that they're going to work hard for you. But also, you need to know who their backers are. And if you can, get their names. In other words, if somebody says, well, Canaccord has supported me, has supported me consistently, who? Do they support you now? How much stock do they have? Do they have a ROFR on a future financing? Don't just show me. Don't just tell me. Show me.
So this is quoted as Rick's favorite, and I totally agree with this. And I think it would be really illuminating, let's say, if you asked this of a CEO or a management team and they didn't have an answer to this. So the question is, what can go wrong? How can I know what is going wrong? And what will you do if it does go wrong?
Tom, whenever I particularly subscribe for a placement, but whenever I have a big position, I have a plan and I have a written plan. It doesn't have to be really detailed. It can be 2 pages, but I have a plan. And I have an unwritten rule for myself that if I don't know 3 things that really bother me about a company, if I don't know 3 things that I'm afraid of, I don't know enough about the company to make the investment. And I found that by asking various people around the company, but in particular, the dominant ego, the promoter, the CEO, about the 3 things that keep him or her up at night, If they don't know at least three things that can go wrong, and if they're not willing to share them with you, you don't know enough to invest. I was visiting with Bob Quartermain the other day about Dakota Resources, his new venture around the old Homestake mine in Lead, North Dakota. And I said, what could go wrong? And he says, oh, Rick, I mean, a myriad of things could go wrong. In the first instance, they've taken almost 40 million ounces out of that camp. Maybe they got it all. My own experience is that big deposits only get bigger. But the first thing is that my thesis could be wrong. The second thing is that we have to explore 18 kilometers of strike. Maybe there is more gold, but with the time and resources that we have available to us, we can't find it. The third thing is that the Black Hills of the Dakotas, are important ancestral First Nations lands, and we have to earn over time the social license to operate, given that the mining community has done a wonderful job of alienating First Nations people. In other words, Bob was able to give me in 60 seconds a very concise list of the challenges. And then he was able to tell me how in the next 18 months, they were going to try and address all those challenges. In other words, he formulated the importance of the challenges, and he formulated a method to deal with them. It's that level of preparation when he looks both at the upside and the downside, and he formulates a work plan around both the upside and the downside that gives you the confidence that the management team that you're involved in knows enough about the task at hand that they have a good chance to succeed.
Mm-hmm. Next one is, who's the promoter? Who's buying the beer? And is this different than who the CEO would be?
It can be. Mm-hmm. If, as an example, with regards to Ivanhoe and Robert Friedland, I said, Robert, where am I going to get my information? Knowing that in addition to everything else, Robert is making movies and doing a bunch of stuff. He has to interface with the Chinese, interface with the Congolese government. I said, Robert, assuming that I'm not going to be able to get information from you, mm-hmm. where can I get information? The first thing he says is, you can call me at 3:00 in the morning, Rick. Well, that's a good off the cuff statement, but he might not answer. So I pushed him a little harder. He says, okay, get out a pen. If your question involves Kapushi, this is who you talk to. This is their number. If the question involves Kamoa Kakula, this is who you call. This is the number. If the question involves the Flat Reef, this is who you call. This is the number. If the question involves capital markets, Peter Meredith, here's the number. This is who you call. If anybody doesn't give you sufficient answer to your questions, this is the woman who's in charge of financial public relations. Call her and tell her that you need to talk to me. Mm-hmm. That's a really good answer. Mm-hmm. It's important that you have access to information on an ongoing basis. If the thesis is that the path to create value is answering a series of unanswered questions, you need to be kept up to date on data acquisition. You need the ability to talk to somebody knowledgeable in a company to interpret the press release for you. If they've drilled 30 holes and they say some notable intercepts include the following, well, that's good. But what do all 30 holes say? What sort of data did you get from all 30 holes? Mm-hmm. Will the person in charge of exploration plot those holes for you and explain to you how those holes in their totality increase your understanding of the deposit? Who will do that? Remember that you're not going to get it right necessarily. You just need to get it right more than your competitors who mm-hmm. don't undertake the process will. Mm-hmm.
So, Rick, again, how does the average investor think about trying to get that information? And obviously, you, let's say, have a privileged position of getting that type of information at times. So, if the average, go ahead, sorry.
The average investor would do well not to invest in companies where the promoter isn't so passionate about what he or she is doing that they can't answer the question. If the promoter says to you, well, Canaccord publishes research on us, that's how they answer the question. Hang up. Just hang up. Throw the file away. Don't involve yourself in fear of missing out. My experience has been that these successful people are so interested in what they're doing and so determined to succeed that rather than getting them to talk, it's difficult to get them to shut up. And they are flattered that somebody cares, truly flattered that somebody cares. I have had hundreds of clients in my 35 years of active involvement managing people's money and resources who have reported to me, to their amazement, that when they used my techniques, when they called up the financial PR person, that the financial PR person had moved them on to the CEO saying, this guy's actually a living, breathing, real prospect. This person's not a waste of time. And that the CEO or the promoter then introduced them to the VP exploration. The people who are serially successful are so viscerally involved in the process that they love to participate in this kind of thing. It flatters them.
So, Rick, have you seen a major change, let's say, over the last 30 plus years in the way that any of this information is communicated? You know, we live in an age where you can put out, if you're the head of a company, you can choose to put out, 5 emails a day or tweet about it, do interviews about progress, anything like that. Do you find that companies are more willing and able to put that information out publicly?
I found that companies, I shouldn't say that. I find that companies continue, unfortunately, to be very interested in putting up misinformation. A lot of promotion seems to involve hyperbolic and misleading headlines. But what I've also found is that there is so much information online that peer-to-peer learning is infinitely more important than it used to be. And the searchable databases, particularly Edgar and Sedar, are invaluable tools. 30 years ago, when I evaluated companies, I would get 5 years of quarterly reports, which is to say 20 quarterly reports. I'd take the staples out of them, and I'd put the income statements in sequence, and I'd put the balance sheets in sequence, and I'd put the notes in sequence, and I would attempt to reconstruct on a physical basis the interplay between the balance sheet and the income statement over time. I would pay attention to, if it were available, to the sort of CEO statement about what they'd achieved and what they hope to achieve in the future, and see whether the expenditures really involved what the CEO suggested that the expenditures did involve. I can do that now. And this process, by the way, in those days might have taken me 100 hours. I can do the same thing online now with Sedar and Edgar, and I can get it done in an hour. Using technology, using publicly available spreadsheets to import information from Edgar and Sedar, and reconstructing the interplay between the balance sheet and the income statement now is infinitely faster. Absolutely infinitely faster. Paying attention to companies' promotional strategies, so that if they tell you that their constituency, as an example, is the European institution, but all of their promotion is geared to the Canadian punter, tells you a lot about the disconnect between who they say their audience is and who they actually believe their audience to be. And again, you can ascertain that all online. There have been some very high-profile Canadian companies where looking at the income statement over 5 years, you learn that their expenditures on financial public relations exceeded their field expenditures. Now, what you learn with that simple fact is that these are promotional vehicles. These aren't exploration companies. Mm-hmm. And if you are very good at trading a public narrative, in other words, what you really care about is a management team's ability to economically access stupid people and sell them stock, this isn't a bad speculative technique. It's not something that interests me because I'm not a narrative investor. But examining the data will tell you much more about the investment proposition that's in front of you than not examining the data. And data is much more available now.
Mm-hmm. Excellent, Rick. Well, I think that kind of wraps up all those questions. Do you think we touched on everything that we should have thought about?
I do. And by the way, if the list sounds daunting, you don't have to get a yes answer to every question. Mm-hmm. You apply these in the understanding that what you're looking at is a range of probabilities. You aren't going to get a perfect yes to every answer. I think it's important that you apply this. What's really of interest to me with this interview is, of course, I'm putting on the Natural Resources Investment Symposium in Boca Raton, Florida. I'm asking people to take 4 days out of their life, come down to Boca and become better investors. I'm asking them in particular to become better investors because there will be 40-something exhibitors there, each of whom I own. The criterion for exhibiting there isn't just a check that cashes. I have to know the companies well enough that I've invested my and my clients' money in them. It's important when the attendees to this conference go to the conference and they're asking exhibitors questions, that they ask exhibitors questions from the point of view of making real valuation determinations. And having a framework to do this, a framework as an example like we've just given, that is the result of processes that I've employed over 40 years, is a wonderful way to start.
Mm-hmm. Excellent, Rick. Well, I think that's like you say, that's a great framework in order to start evaluating these companies. Of course, I think this is going to be a learning process for investors over time, and you're only going to get better at it. I've gotten a lot of questions kind of in the same vein here over the past couple of weeks here, and I wonder if we could take just a couple minutes to address some of those.
I'd be delighted to the extent that I can.
So the first one of those would be, should we have sold positions when the Fed started hiking rates to be in cash and be ready for the eventual turn in mining stocks? That kind of revisits.
Should is a word that has no meaning in speculation. Mm-hmm. Hindsight is always 20/20. A better question might be, if you believe that interest rates are going higher and the dollar is going to get stronger, should you sell now? Mm-hmm. Shoulda, coulda, woulda is an excuse to do nothing. And hindsight, 2020 has no net present value. Mm-hmm. It is likely that if U.S. interest rates continue to go up and the U.S. dollar continues to be strong relative to other currencies, that commodities markets, including precious metals markets, will be weaker than they otherwise would be. Mm-hmm. My own belief is that sometimes things are cheap enough, and that although some of these shares might get cheaper, what I try to be is an absolute value buyer. I don't try to forecast what the market's going to do. I rather try to forecast whether I'm able to buy dollar bills for 80 cents or not. Mm-hmm. That's what's more important to me. Two, I'm not particularly a trader. I normally don't own stocks for the 3-month time frame, but rather I try to own stocks for the 5-year time frame. Mm-hmm. And I'm personally very, very, very willing, if I've bought a share of stock for $1, to buy much more at 80 cents if it falls to that price, because I've already done the work to develop the intellectual capital to keep my physical capital company. Mm-hmm. I'm not bothered by those circumstances at all. But some of your listeners may be. Some of your listeners may be traders as opposed to investors. Mm-hmm. They may be narrative oriented as opposed to valuation oriented. It's important that the investor analyzes himself or herself with the same sort of rigor that they try to analyze their companies.
Excellent answer, Rick. I think those are great things to take into account there. Next one would be, when the dollar ceases to be the reserve currency of the world, will the Fed become just another central bank and unable to wield any special influence on the world's monetary system? Is that when I will have to buy gold?
The lady or gentleman is asking for a simple definitive answer. I would suggest that I'm 69 years of age and very healthy, so I expect to be cognizant for another 30 years. And I suspect that the US dollar will be the world's reserve currency when I shed my mortal coil, which is to say for at least 30 more years. My friend Doug Casey calls the dollar the prettiest mare at the slaughterhouse, which suggests that given all of the dollar's weaknesses and our society's weaknesses, it's still stronger than all of the viable competitors. Mm-hmm. So I don't believe that the US dollar will lose its reserve currency status. I believe that its dominance may become less pervasive as other people begin to object to the extraterritorial application of US law. But I suspect that the US dollar will be the world's reserve currency for a long time. And I believe that the Fed will be the most important actor on the global financial scene for a long time. I believe, too, that that the dollar will retain its predominance over gold. But I believe that the dominance will be less pronounced. In the US, the market share of precious metals and precious metals related assets relative to other asset classes is less than 0.5%, which is to say less than 0.5% of savings and investment assets in the United States are comprised of precious metals and precious metals securities. The 40-year mean market share of precious metals is between 1.5% and 2%. So while I believe that the US dollar will continue its predominance, what I think is that precious metals and precious metals related assets will at least regain their former market share. In my heart of hearts, I believe that they'll overshoot. But if they just reverted to mean, demand for precious metals and precious metals related assets in US dollar terms would triple or quadruple. And I think that that'll happen within the 5-year time frame. Mm-hmm. Even given the predominance of the dollar and even given the predominance of the Fed.
Rick, do you think part of that, let's say the dollar remaining the world reserve currency is based on the fact that they would, whoever tries to come along and challenge it would need it to become and look more attractive to the entire world to use as a means of exchange over the dollar? Absolutely.
The US has the incumbent's advantage, which is to say that it is the world's reserve currency. Stasis never occurs, but it's always the best bet. Mm-hmm. In addition to that, for all of our faults, we are still the most transparent and the most liquid economy in the world. Some years ago, I believe 2012, 2013, I personally had occasion to interview the senior person at a very, very, very large Asian sovereign wealth fund. And I was interested to learn that a substantial amount of the assets in the sovereign wealth fund were US Treasury securities, long-dated US Treasury securities. And I said to this person, are you concerned about the value proposition associated with this? I happen to love the fact that your portfolio is dominated with US dollar securities because you guys send us all kinds of cool stuff, steel, ships, computers, all that stuff. And we send you back pieces of paper with dreams painted on them. He sort of chuckled. And I said, it seems to me on occasion that US Treasury securities are a lie. And I remember he looked at me and smiled. He says, yes, Rick, what you say is true, but yours is a deep and liquid lie, unlike all of the other lies I get told. And I said, so do you trust us? He says, oh, no. But we, meaning Asians, trust you much more than we trust each other. And when Doug Casey describes the US dollar as the prettiest mare at the slaughterhouse, what he goes to is the lack of a viable alternative.
And, my last question, Rick, is very in line with that as well, is as long as the USD is paired with the euro, how can we ever have true price discovery in the metals?
It takes a long time. remember that we don't have to have true price discovery to make money. Prices are set by values. And if there's 8 billion of us on Earth, there's 8 billion different values. What I believe in is the probability that people will act in their own volition, their own best interest. I believe that the biggest investors in the world, the sovereign wealth funds, the pension funds, the endowments, will look at their current portfolios where on average 40% of the portfolio is made up of debt securities, and where those debt securities are generating interest yields that are below the rate of purchasing power depreciation of savings instruments. And they will understand that having 40% of their portfolios in long-dated debt instruments guarantees that they won't be able to fulfill their obligation to their beneficiaries. The result of that will be, I think, disintermediation on a big scale from the long-term bond market. And I believe that some of the proceeds of that disintermediation will flow into an asset class that has a millennium long track record in terms of sheltering money from inflation, which is to say gold, silver, and precious metals. I believe at the root of things that both the dollar and the euro are floating abstractions. Doug Casey calls the dollar an I owe you nothing. He calls the euro a who owes you nothing. And while I believe that those floating abstractions serve utility to the political class and will continue to be the dominant mediums of exchange, I believe that structural weakness, particularly with regards to the debt market, means that without price discovery, precious metals and precious metals related assets will, as I say, at least revert to mean, which means that demand will triple or quadruple, irrespective of your belief as to what their value should be.
And of course, there's a quote that I remember seeing you say on an interview with Doug, is that when you're compared to him, you look like a raging optimist, right?
Yeah, I love interviews with Doug, first of all, because he's so smart and because he thinks of things as so differently than other people. He challenges me all the time. I learn a lot from him because he's not bound by sort of conventional strictures. He's an avid reader and he's got an avid imagination. But what really makes it useful to me is that most people regard me as, let's just say, an aggressive and unusual thinker. Compared to Doug, I'm a hot-eyed moderate.
Well, it's excellent to be able to, have the perspective of our last interview together, and then speaking with Doug in between this conversation and our previous one, and that gives me a particular perspective that I can exactly see what you're saying about the different ways that you two think about things.
Well, I would encourage you to have Doug on as often as you can attract him. I have found him to be a delightful human being and an absolutely original thinker. That isn't to say that either Doug Casey or Rick Rule are gurus. Don't imagine by any stretch of the imagination that we're going to be right in every circumstance. But understand that when you talk to Doug Casey, you get deep thinking that you wouldn't get from CNBC or other sources. And it's important to open your mind in that regard.
Well, and of course, you have both made, in some ways, a lifetime of mistakes that you have mostly learned from, I'm sure, and are able to apply those lessons going forward, right?
Absolutely. I used to joke that when I was a stockbroker, the transaction really involved me trading scar tissue for commissions. And from the point of view who was paying the commissions, that was a really good deal.
Yeah, no doubt. Rick, remind us of when and where the Natural Resources Symposium will be this year.
Absolutely. Hopefully we sent you a link, or we will send you a link. But the Natural Resources Investment Symposium will take place this year in Boca Raton, Florida. After many years of putting it on in Vancouver, British Columbia, the public health challenges around an international border and COVID made that undoable. And I really want people to come. This is going to be an unvarnished commercial, but we have wonderful big picture macro thinkers there. Daniela DiMartino Booth, Jim Rickards, Grant Williams, Doug Casey, Nomi Prinz, people who can put what's really happening in the world in context that you can use. Then we have some of the best analysts that have ever lived around natural resources on stage. So once your big picture thesis is put in place, you can learn how to implement strategies that can put that thesis into either protection or wealth generation. More importantly than that, we have for 30 years focused on the living legends. We'll have people on the podium who have built multi-billion-dollar natural resource companies from scratch, telling you how they did it. More importantly, telling you how the lessons that they learned made them a better investor and can help make you a better investor too. Mm-hmm. Finally, where the rubber meets the road, every exhibitor at our conference, every public company exhibitor is owned in an account that I manage. That doesn't mean, Tom, sadly, that every stock I buy goes up. What it does mean is that while at most conferences, the qualification to be an exhibitor means that your check cashes, at my conference, I have subjected all of them to the questions that you and I just discussed, which is to say they have been properly vetted. The upshot of all of that is that over 30 years, every investor education product that I've always put up came with a full money back guarantee. Mm-hmm. If you pay the tuition necessary to attend the Boca Raton Natural Resources Investor Symposium and you don't think you got your money's worth, email me and I'll give you your money back. Full 100% money back guarantee. This is easy for me to do. In 30 years of presenting investment content, the content has been good enough that we have had to make refunds of less than 0.1% of the tuitions that we've received. Mm-hmm. So July 26th through 29th, Boca Raton, Florida. More information available at the link below. I would also like to say, as I always do to your audience, Tom, if you'd like to engage in discussions with me, I encourage it. And the way I encourage it in particular is asking anybody who cares about my thoughts of natural resources in general, but more importantly, their portfolio in particular, to go to a website, Rural Investment Media. List your natural resource portfolio, and I'll rank them 1 to 10, 1 being best, 10 being worst. In addition, if you care about the private placements that I personally am participating in, if you were an accredited investor, write down placements. It turns out that I can give you information about those placements because I'm not soliciting, because I'm retired. I don't get paid. It's at least thus far for free. It's not a subscription-based product. So write placements. Finally, I'm celebrating retirement by starting another bank. If you are unhappy with your current banking relationship, which I suspect extends to every single listener you have, in the question and comment section at ruralinvestmentmedia.com, write bank, and I'll send you information on Battle Bank, which is our new bank and organization. So placements, conference, rankings, bank.
I think you have every base covered there for our entire audience, Rick.
I am delighted to still be able to be relevant in retirement for some of them.
Excellent. Well, Rick, as always, I really appreciate your time and all of your expertise and the knowledge that you shared with us today. I'm sure it will be invaluable for those that are willing to put the work in and really take these lessons to heart.
Well, thank you for the opportunity. I love this particular series of questions. It interests me, and I found it helpful to those who listen to it.
Mm-hmm. Excellent, Rick. Thanks for your time today.
Thank you, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.